All right, welcome to the Marhelm market update here on Thursday afternoon. I just took this screen grab from the Marhelm homepage tracking the global shipping equities. And as of this afternoon, you can see that tankers are having a bit of a bad day. Frontline pulling back about 4%. But, generally for the year, tankers have been relatively solid, all green year to date across the board. Frontline had gotten up as high as probably 120% of NAV, and so they're pulling back kind of the steepest here. But generally, the LR2 market has been quite firm to start the year. It's taken a little bit of a breather on the Red Sea situation, but market participants expect it to stay quite strong. The VLCC market and the AG, obviously, it's taken the brunt of a lot of the headline risk around OPEC cuts and whatnot. It's also taking a little bit of a breather, but discussion of the second half of the year as there'll be no more fleet growth in the VLCC market this year. Okeanis has continued to perform well on good trading of their vessels and capital return. The real story of the year to date has been the dry bulk market, and I'll get into a little bit more of that later in the presentation. But, year to date, Grindrod is really the outlier. Taylor Maritime has decided to buy out the remaining 12% of the company that they didn't own, and they put in a relatively attractive bid for that, higher than kind of the market had expected they would need to buy that back in. So that has traded up on that. But other than that, the real story this year has been in the Cape market. We started off the year at very high, iron ore prices coming out of the fourth quarter. Those promptly essentially fell off a cliff, and the Capes have, kind of reacted similarly. But, as I'll show you in another slide here, over the last 6 months, some of these guys are up about 70%. LNG, this has been a super interesting space to watch. A very kind of differentiated profile here. So, DLNG has led the pack year to date, and that's mainly due to the fact that it's been one off of people's radars. It's a very small company. They have a mid-aged fleet. There was some risk around Yamal LNG, where 2 of their vessels are on charter, and it's also one of the failed MLP models. So it's been kind of out of sight, out of mind. That said, they're in process of refinancing the entity, and all their ships are now fully chartered into 2028 at quite healthy levels. So I think this is one to watch there. It's still quite undervalued given the cash flows that they have locked in for the next couple of years. On the other hand, Flex and Coolco, they've traded off this year mainly due to their rechartering risk that they have. The LNG market's been quite weak, and so the market has discounted the levels that they're going to be able to recharter some of their assets at. Another interesting story to watch has been Golar LNG. While it's only up 7% year to date, after their earnings, they did trade off, and so from there, it's traded up over 20%. They're making progress on announcing new projects for the Hilli, and potentially some new asset deals. There was a rumor that they were going to send the Hilli, or had won a contract in Argentina with YPF. That's yet to be substantiated, but they did just hire a new CCO. They continue to put out press releases and commentary to the market that they have a signed agreement, and they're working towards an announcement there. So definitely one to watch there. LPG, that has been a highly volatile sector. They were the most benefited last year from the the situation in Panama. The equities ran all of 2023. Then to start the year, they all kind of crashed back off. And so year to date, these guys are all still down, as you can see, some more than others. But they seem to have hit a bit of a bottom the last month. You're starting to see some green, especially with BW and Avance Gas. And so, it's definitely an area to keep an eye on. Navigator Gas is generally flat. This one kind of falls into a different bucket, given one, the mid-size nature of their vessels, and also, the long-term project they have with Enterprise in Houston. So it's less volatile than some of the pure tonnage providers. On the conglomerate side, Navios has been a huge story this year. The CEO Angeliki had come out, probably about a month ago now, and had bought over 10 million in the open market. And so when that news came out, stock went from 30 to low 40s pretty quickly, and now has been kind of building a base there. So, the NAV on that stock is, call it 110, 120. So, you're still at a huge discount to NAV. Should the company go forward with, what the market hopes and what the market is anticipating, and buys back shares in the open market, you could really see another leg up quite quickly on Navios. Not to mention, Capes, LR2, some of the tankers they have, they've generally been performing well in the market. And then the container market, that's been a tricky one to start the year. Obviously, Zim is hovering around $10 here. They're down on the year after kind of spiking on the Red Sea stuff. But, the Jefferies analyst has come out recently with a buy, saying it's a good entry point here. They have been making money all of first quarter and now into second quarter. So, there's a chance that they could announce decent earnings on their first quarter call, which maybe will catch the high short interest offsides. But it's definitely a volatile one to keep an eye on. And then GSL and MPCC have kind of led the pack. MPCC will be joining Marhelm for an investor meeting in a week or two. So, tune into that. They have mostly feeder container ships, which have been, have held up better than some of the larger container ships in this kind of container crash, if you will. Although not much of a crash, given it's, you're still up a lot from fourth quarter, and you're generally much higher than the averages for 2023. But from the peak in January with the Red Sea situation, they have, given back some of those gains. But on the container side, they're still making money. The asset side, charter rates have held up okay. But so we recently did a deep dive on Vale, which is the Brazilian iron ore producer, and also have taken a look at the Cape market, just given the volatility there. So, Vale, this is year to date, is down, 23%. We put out the report, I think at this actual bottom right here, which was good timing. They recently announced that they're ahead of expectations on iron ore production this year. So it's one to watch. This here's two kind of screen grabs from the report that we put out. Last year on a TTM basis, the dividend payment was about 15% on the share price from earlier this week. It has come up slightly from there. And we believe that, the dividend, they've still been able to pay down debt, and the equity value is growing, and their production capacity is growing. So we don't think that the dividend has kind of hindered the company. It's quite strong on a fundamental front. And it trades at a discount to its peers, as we show here. So if you're interested, a couple of takeaways. There are concerns with the iron ore and steel market. There's a lot of mixed news in China. something to watch. Potentially some risks to Vale, at these levels. Iron ore has bounced off of 100, but has come down from 150 in January. So we don't expect a total collapse in iron ore prices. We see really good value in owning the stock in the high single digits, but even here between, call it 11 and 13, there's you have a very good entry point. And then if you look at some of the premiums you can get on $10 puts and $12 2025 calls, we think there's some interesting plays there. So if you're interested in that, please reach out to discuss further. On the Cape market, so you can, if you zoom in on this 6-month chart, you'll see that the Capes have really led the dry bulk pack. And some of these guys up over 70% the last 6 months. And you can see the volatility here in iron ore prices. So, a lot of people got caught off sides over the third and fourth quarter. Iron ore ripped up. I think it peaked, close to 150 in January. It crashed down to below 100 recently and has bounced off the bottom a little bit. So iron ore prices have been quite volatile, something to definitely watch in the Cape market. Chinese inventories have crept up. That said, they're still at historically, healthy to positive levels, but something to keep an eye on. From our Cape report, we just put out another clip here on the right, a screen grab from a Himalaya shipping report that talks about the additional capacity coming online at Rio Tinto and Vale. And it's going to be a lot of iron ore. So assuming the market can absorb the additional capacity that they're building, you would expect to need, upwards potentially of over 140, 145 Capes. And there's less than that on order. So the order book in Capes remains about, call it 5%, historically a very low level. You have, a huge amount of the fleet was built between 09 and 11. As those ships over the next, call it 3 to 5 years, hit 15 to 20 years old, with the environmental regulations coming into place, with the age of the fleet, and with the lack of ordering, we think you're going to see continued kind of upside volatility in that market. So, there's a few names that you can play on the Cape front. Himalaya Shipping is one of the pure play. They're having their last few new builds just deliver. So they're going to have 12 brand new Newcastle Maxes on the water. These are LNG dual fueled. So the benefit of Himalaya is that, as these environmental regulations come into place, having the ability to run on LNG kind of removes you from some of the older Capes potentially may need to slow down or do engine modifications for the EEXI and other EU carbon regulations. And also the price of LNG has been quite low. So assuming you continue to see low LNG, natural gas prices, they should stand at a benefit from being able to burn both, traditional oil as well as LNG. So, they get a strong premium to the Baltic index due to, one, the size of having the Newcastle Maxes, plus the scrubber / LNG. It can be north of 40% premium, and they're paying out all the dividends every month. So, in this case, it's more of an investment vehicle. You don't have to worry about management going rogue or investing in other asset classes. You are buying into the 12 ships, and they're returning the capital to shareholders. So quite straightforward. Similarly, 2020 Bulkers is a similar setup. Granted, their ships were built, a few years prior, so they are not LNG dual fuel, but they do have scrubbers. They recently just sold 2 of their ships. So the benefit there is that, the full entity is up and running. Potentially a little bit lower break even. They've been paying out dividends. They just announced the special dividend. One of the risks there is that with the sale of the Capes, it's a little bit unclear as to what the strategy is, whether they'll sell more ships. Clearly, the asset values in Capes really skyrocketed, so it might have made sense to take some profits there, but it's unclear if that's going to continue or where they'll stand. You also have ship Synergy Maritime. The benefit here is that you're buying into more of a mid-aged fleet with a low book value. It's a little bit more of a volatile stock, just given one, it did become a meme stock for a little bit in 2021, but management has done a good job of continuing to add tonnage to grow the fleet, and they have been in repurchases over time. You'll need to see the market continue to stay strong for that to ramp up this year. So the risk here is that management will prioritize kind of growing the fleet a little bit or fleet renewal instead of dividends or repurchases. Golden Ocean, that's been kind of the big story to start the year. They've really they've caught up. Essentially, they were a bit surpassed by Himalaya in 2020, but they made up some ground to start the year. Ironically, if you look at the year chart versus the Baltic Cape Index, they're both up about the same. Granted, at one point the Baltic Cape Index was up over 300%, but it's come back down. So it's interesting to see how they trade. They have traded pretty much in line with the 1 year Cape TC rate. That said, they did a great job in 2020, 2021 of putting in some new build orders, which are hitting the market in not just Capes, but also Kamsarmax and elsewhere. So you get a little bit more of a diversified fleet, but being a Fredriksen-owned company, you can always count on shareholder return. And then you have Genco and Safe Bulkers. Genco, this is also a great company. You get the Cape exposure, but they also have Ultramax and Supermax. So if you're looking for more of a steady, maybe mid to longer term play, you get the benefit of, traditionally, Capes have been quite volatile, whereas Ultramax and Supermax have been more steady as you go. So in theory there, you would get a little bit less volatility in earnings. They've paid down debt substantially, I think below 10%. So they have a formula for their dividends. So given their leverage levels, you should expect solid shareholder returns there. And then Safe Bulkers, they have more of a diversified fleet as well. They essentially forewent dividends during the last mini boom in the dry bulk market in 2021, put in new build orders, kind of found themselves in the penalty box with investors. That said, they do trade at a probably a 50% discount to NAV, and so expect as those ships hit the water, if the market stays strong, sentiment might change on them, and they could kind of close that valuation gap a bit. So just wanted to give you guys a brief update on what we're looking at in dry bulk, iron ore with Vale, as well as the broader shipping market. There's always a sector within shipping that seems to be in favor, and so at Marhelm we're trying to identify those and follow those. So feel free to reach out or request a demo if you'd like to talk more about any of these theses. Have a good afternoon.